The information provided in this program is of a general nature and is not intended to be personalised financial advice. We encourage you to seek appropriate advice from a qualified professional to suit your individual circumstances. Apparently no news is good news on the aged care industry. Forsyth Barr on why it's the sector to watch this reporting season.
If they're boring results, I think that could definitely be enough to act as a at least smallish catalyst to move them a bit higher.
And listed property is stuck in limbo as the value of their portfolios decline.
We've probably seen valuation losses of, circa 5 to 10%.
It's Friday the 12th of May and you're watching Markets with Madison. Reporting season kicks off next week with 23 NZX companies revealing their mostly full-year financial results. Analysts are picking property and aged care as the sectors to keep a close eye on. Their sensitivity to falling asset prices and interest rate rises have made them the poorest performing sectors on our market over the past year. Investors have derated aged care by 25%, with Ryman's recent capital raise just hurting others. But we could finally be in for some upside opportunity. Aaron Ibbotson from Forsyth Barr is an aged care expert. Hey Aaron, good to see you.
Good to see you, Madhu. Thank you for having me.
Aged care stocks clearly need a boost. What, if anything, could be a catalyst for some upside opportunity this reporting season?
Well, good question. They've certainly lacked positive catalysts. I think we're coming up to 18 months now when they've been performing very poorly. I think this earnings season focus is going to be a little bit different from what it has been historically. I think there will be a lot of focus on cash generation. I think there might be a lot of focus on costs. As you may or may not know, there's been a lot of cost growth over COVID. Some of that could come out. But the big catalyst that everyone is waiting for and which they can't do much about is house prices. House prices and house sentiment and turnover in the housing market.
Now, you've said that no news could be good news for the aged care sector. What do you mean by that?
Well, there's the market trades a lot on hope and fear. And when stocks do well into earnings, in between earnings, there's a lot of hope. And if they don't deliver, they can perform quite poorly. But the opposite also holds true. So the aged care names have performed, very poorly for a long time. And I think that sort of builds up fear that something, nasty and surprising or something is going to happen when they report results. But if they have boring results, I think that could definitely be enough to act as a at least smallish catalyst to move them a bit higher.
It hasn't been a boring year at all for aged care, though, has it, Aaron? I mean, we had that big Ryman capital raise. We also had a bit of a lacklustre first quarter result that came from Arvida. So what's the sort of setup going into this earnings season for these aged care companies?
Yeah, I think you're very right. It's been a lot of big events. We've had, pretty much the most rapid and biggest house price decline for 40 years. We've had interest rates going through the roof. Obviously, these two are very intimately connected. And on top of that, we actually, even though we've forgotten about it now, had COVID, through the country less than a year ago. So it's been a quite exciting year. The setup now, I think, is first of all, there's some worries, I think, around leverage across the sector. So I think it's clearly about discipline around cash flow. I think the market's tolerance, if I put it that way, for continued debt buildup is quite low. I think we will see some debt buildup in this earnings season for both Arvida and Oceania, and also for Ryman, if you exclude the massive capital increase that you mentioned. But I think it's important that they guide and talk to FY24, so the coming 12 months, that they will focus on at the very least keeping that debt stable and maybe even reducing it somewhat.
On cash generation and demand, what would be the best case scenario that you could be looking out for?
Yeah, on the demand side, if I start there, I think the most important thing, our best case scenario, is that they talk to a meaningful pickup in the most sort of post-period end, and the period end for these guys are at the end of March. So that you've seen a pickup in April and even in May. They quite often comment on the most recent weeks. So I think that's one sort of good case scenario at least. I think a best case scenario, particularly around cash generation, would be for, if you look at Ryman, which is the big one, a best case scenario for me is that they are cash flow break even in the half. I don't think that they will be. I think they'll build maybe 100 million or so of debt, but I don't think it's impossible.
Now, Aaron, outside of aged care, you're warning that Fisher Paykel Healthcare could be hit this season. What makes you think that?
Yeah, I guess in a way it's sort of the opposite situation of aged care, in the sense that the stock has performed very well recently. It is on an, what we would argue an extremely high valuation. And it seems like there's a lot of hope built into the stock at the moment. There's a lot of hope that maybe they will beat numbers significantly or guide towards, a very strong demand, or you will see some significant upgrade cycle coming. And we struggle to see that. And, if they come out again, if they come out with sort of an inline-ish result, no drama, it is difficult for us to see how it doesn't lose a little bit of its multiple. So, on our numbers, it's on close to 50 times 12 months forward earning. That's an extraordinary high multiple, even for what is undoubtedly a very high quality business.
We will wait and see. Thanks so much for your time, Aaron. Good to chat.
Thank you so much for having me.
Our listed real estate names are a bit stuck at the moment, with their ability to grow limited in this higher interest rate environment. Jarden's Head of Research, Ari Decker, has reviewed all of their recent valuation drops. Ari, good to see you.
Likewise.
What scale of valuation losses have you seen across the listed property sector just this year?
Yeah, well, for those companies reporting firstly in February and now in May, we've probably seen valuation losses of circa 5 to 10%. As transaction evidence starts to come through and support the valuers and sort of providing some evidence of where the market sits. And look, that hasn't been a surprise, in the listed sector. Already, a number of the companies are trading at pretty substantial discounts to their book valuations, recognising that, there would be some valuation softness.
Should investors expect to see any more losses revealed on top of those that have already been announced, or more losses from other names?
No, not this season. There may still be some further valuation softness, in future reporting periods, but those indicative valuations that the companies have come out with, they should land pretty close to that.
All right, so what does all of this mean for their banking covenants? Could they have breached some of them?
No, the sector's, generally in pretty good health with regards covenant levels. Obviously this does see, loan to value ratios, expand out a bit, but not towards covenant levels.
With rates apparently near their peak, how much relief could that bring to the listed property sector?
Yeah, so rates have an impact on the sector in a couple of ways. Obviously, rates do influence where valuations sort of end up landing. And it's possible, those valuations are informed by market evidence as much as anything. So rates may settle, but we may still see some valuation softness from here. The other, key driver with those rates is on the borrowing costs of the sector. There has been hedging that's provided a buffer to earnings for a number of the listed operators, but as they come off their hedging and are exposed to these higher interest rates, that will manifest itself in higher borrowing costs, and earnings will have the potential to flatten a bit.
Given that environment, their growth is pretty much tapped out right now, isn't it?
Yeah, so there's a couple of things. It's harder to get new development opportunities underway, with higher borrowing costs and that sort of thing. So we've seen a little bit less activity, in terms of new developments being committed. I guess the other thing is with loan to valuation ratios, while they sit well below covenant levels, they don't sit at levels that provide as much capacity to commit to new acquisitions and those sorts of things. And so we've seen activity in the sector sort of, slow down a little bit, from a growth perspective in response to some of those drivers.
So what can these listed property companies look to do? Is there opportunity still to be had in increasing rents, perhaps, or could they look to raise equity to have more money to do something with?
Yeah, so a couple of things there. Certainly in the industrial space, and also actually in premium CBD office, rental growth's been pretty good, and that's definitely providing a bit of offset to the increase in cap rates influencing valuation. So not all of the sectors are exposed in the same way there. I think what we're sort of seeing, some of the listed operators do at the moment is that they're recycling out of some of their non-core assets. So there's a bit of recycling activity happening, which will obviously open up some capacity to take new things on. And then ultimately, for those operators, particularly those with, a lot of growth opportunities and a strategy to continue to grow their asset bases, ultimately raising equity capital is another means to, but at the moment that doesn't seem to be on the cards for many in the sector.
Thanks for your time, Ari.
Thank you.
Well, speaking of interest rates, the world could be in for some relief on that front after the pace of inflation in the US slowed for a 10th consecutive month in April. To talk us through the highs and lows of it, I'm joined by Greg Smith from Devon Funds. Hey, Greg, thanks for coming on the show.
My pleasure. Great to be here, Miss.
How thrilled should JPAL be with this inflation print?
Yeah, quite positive. Yeah, and I guess that the trend is your friend, and we're seeing inflation falling, which is good news. So, at the headline level, it came in at 4.9% on a year ago, and that was below expectations for 5%. Month on month, it was 0.4%, which was in line. But yeah, look, you saw equity markets increase, particularly rate-sensitive ones. So the Nasdaq was up 1%. You saw yields decline, and you saw treasuries rally in the US. Dollar fell. So that was all pretty positive. Look, there were some aspects of it, worthy of note in terms of compositional changes. So the stuff that's been quite persistent from an inflation perspective, where there was some good news and there was some, not as good news. So shelter, which is 40% of the CPI, and that's remained quite persistent, still running at about 8%. But yeah, great news on the food front. And you talk about JPAL and I suppose all the challenges consumers are facing. Food inflation running at 7%, but you think about where that got to last August, it was sort of 13%. Things like the price of milk, the price of eggs, they're all dropping. So yeah, I think that will be very well received.
Does this mean that the Fed's tightening cycle is working or not? Because 4.9% is still a heck of a high number, Greg.
It is, but you think about where it was. You're talking about sort of levels around 9%. So it's come down, and it was never going to come down overnight. It's been a gradual process. Obviously inflation shot up during the pandemic. There's a price to pay on the other side, and that has been those rate increases. So it's been one of the most aggressive tightening programs on record. But obviously after one of the most aggressive amounts of stimulus on record during the pandemic. So, look, it's coming down. It's worth pointing out, of course, that the Fed's inflation goal is 2%. So we're a long way from that. But look, it's heading in the right direction.
Markets are pricing in a rate hike pause or even rate cuts from the Fed later this year. Does this inflation print speed up the possibility of that happening, or does this just solidify what markets already had priced in?
Yeah, I think so. So following that, the CPI, the markets are now pricing in a 20% chance of an increase at the next meeting. So the balance of probability is that there'll be no change. Of course, markets are pricing in a cut later in the year. And that's also on the view, obviously, that the economy is slowing down. And look, it really depends what sort of landing we get economically. The Fed wants to achieve a soft landing, and they want to actually avoid a recession. If that doesn't happen and we do get a recession, it depends on sort of what type, and they could well be cutting later in the year, which would mean that we are in those recessionary conditions. The Goldilocks sort of outcome is that obviously the rate cuts work, inflation continues to fall, but we sort of achieve the softish landing. So I think things are still evenly poised in that respect.
Thanks, Greg.
My pleasure.
Here's what you need to know about the week that was. The US company Allbirds, that makes shoes and clothes out of our merino wool, is struggling. Its first quarter net loss widened to $35 million US, compared with a loss of about $22 million just a year ago. It's introduced a transformation plan to try and reconnect with environmentally conscious consumers. But in the meantime, it's had to discount more product, causing its revenue to fall 13%. Another American company that we like to claim as our own, Rocket Lab, nearly doubled its quarterly net loss to $45.5 million US. That's as it spends millions of dollars building a new, bigger rocket to launch from its new site in Virginia. Its revenue did increase as more customers sign up to use its existing smaller rocket. And Warren Buffett's investment firm Berkshire Hathaway had its annual meeting, one of my favourite meetings of the year. He's recently ditched his holdings in US bank stocks, except for one, and he couldn't help but make a dig at them.
Well, anticipating a few questions on banks, I decided we should start using bank language here to describe and Charlie.
Well, Buffy, here's my one. Email yours to me. I want to see them. Now go put your money to work. Thanks for watching Markets with Madison, the New Zealand Herald show for interested investors. If you want to stay up to date with financial markets, click the subscribe button below, and you can watch our other episodes here. Stay up to date with all the business news and numbers as they land on nzherald.co.nz.